Let's get one thing straight. Taxes are not some big scary monster hiding under your bed. They're just a part of life, like getting a flat tire or your team losing the grand final. It happens. But unlike a footy loss, taxes actually do something useful. They pay for the roads we drive on. They fund the hospitals that look after us when we're sick. They pay the teachers who educate our kids and the police who keep our streets safe. So, while no one loves paying them, they're not the villain in this story. They're the cost of living in a country that works. Think of it like a giant share house. You and a few million of your closest mates all live together in a country called Australia. To keep the lights on, the water running, and the place from falling apart, everyone has to chip in. That's all taxes are. It's your contribution to the national kitty. The government is just the housemate in charge of collecting the money and paying the bills. Sometimes they spend it wisely, sometimes they don't. Alright, let's cut through the noise. When it comes to taxes, there are really only two main buckets you need to know about. That's it. Just two. The first one is called direct tax. This is the tax that comes straight out of your pocket. The government knows who you are, knows how much you're earning or own, and takes its cut directly from you. There's no middleman. It's a straight transaction between you and the tax office. It's personal, and the amount you pay is usually linked to your income or wealth. The most common example of a direct tax is income tax. When you get your pay slip from your boss, you see that a chunk of money is already gone before it even hits your bank account. That's the Australian Taxation Office taking its share directly. It's the same if you have a side hustle or run a small business. At the end of the year, you have to tell the government how much you made, and they tell you how much tax you owe. Let's put some real-world names to these tax buckets. The big one in the direct tax bucket is income tax. This is the tax on the money you earn from your job. The more you earn, the higher the percentage you pay. It's like a sliding scale. Your employer withholds this tax from each paycheck and sends it to the tax office for you. This is called pay-as-you-go, or PAYG, withholding. It's the government's way of making sure you don't get a massive, scary bill at the end of the year. It's a little bit of pain spread out over time. Another direct tax is capital gains tax. This sounds complex, but it's not. It's just a tax on the profit you make when you sell an asset that has gone up in value. Investment properties, shares, cryptocurrencies. If you buy shares for $1,000 and sell them a few years later for $5,000, you've made a $4,000 profit, or capital gain. The tax office wants a piece of that profit. It's not a separate tax, but the gain is added to your income for the year, and you're taxed on the total. Over in the indirect tax bucket, the king is the goods and services tax, or GST. So, why does any of this matter? Because money isn't just about what you earn, it's about what you get to keep. Understanding how these two tax buckets work helps you make smarter financial decisions every single day. When you know that income tax is taken directly from your pay, you can plan your budget based on your after-tax income, not the big number at the top of your pay slip. This stops you from overspending and helps you build real savings. It's the difference between wishful thinking and financial reality. If you run a small business, even a weekend lemonade stand, understanding the difference is crucial. The money customers pay you isn't all yours. GST, you have to put aside a portion for GST, an indirect tax, to give to the tax office. Income tax, you also need to save for your income tax, a direct tax, because no one is withholding it for you. Knowing this from day one means you can set up separate bank accounts to hold that tax money. It protects you from accidentally spending the taxman's cut and getting into a whole lot of trouble later. Understanding capital gains tax helps you be a smarter investor. If you hold an asset like shares for more than 12 months before selling, you can get a 50% discount on the capital gains tax you have to pay. So, to recap, direct tax is on what you earn. Indirect tax is on what you spend. Direct, income and wealth, paid by you. Indirect, spending, built into prices, collected by businesses. You still pay, but indirectly. Here's a quick visual. But the truth is, the basic ideas are surprisingly simple. You don't need a fancy degree to get your head around it. You just need someone to explain it in plain English, without the jargon. That's what we're going to do today. We'll break it down so you can stop fearing the taxman and start feeling in control of your money. The first step to not fearing something is understanding it. Once you see how the machine works, you realize it's not that intimidating after all. You wouldn't try to fix your car without knowing what a spark plug is, right? It's the same with your finances. By the end of this, you'll understand the main types of taxes, how they affect you, and how they fit into your life.